Module 2, Return Metrics. Welcome to Module 2. In this section, you'll learn to define, calculate, and interpret various return metrics that are crucial for evaluating the profitability and viability of real estate investments. By the end of this module, you'll be able to compare different investment opportunities using these metrics and make well-informed decisions about where to allocate your capital. So, what are return metrics? These are financial measures that help us understand the profitability and return of our investments. They are key to evaluating whether an investment is worthwhile and how it's performing. Why are they important? Return metrics give us insights into the potential returns and also the risks involved in an investment. They allow investors like us to compare different investment opportunities side by side. Ultimately, they help in making those critical investment decisions about how to use our money. In this module, we're going to cover a comprehensive list of return metrics. We'll discuss cash-on-cash return, return on equity, return on investment, return on assets, nominal and real returns, capitalization rate, equity multiple, absolute return, and finally, the compound annual growth rate. It's quite a list, but we'll go through them step by step. Let's start with a metric that's very popular in real estate, cash-on-cash return. Imagine you've invested your own money into a property. Wouldn't you want to know how much cash you're getting back each year based purely on your specific cash outlay, especially if you've used a loan for part of the purchase? That's exactly what cash-on-cash return tells us. Cash-on-cash return, often abbreviated as COC, is a financial metric that shows the annual return a real estate investor gets on the actual equity capital they've invested in a property. In simpler terms, cash-on-cash return tells you what percentage of your initial cash investment you'll get back in cash each year. It's very focused on the immediate cash flow you receive from your own pocket money invested. Why is it important? This metric is super useful because it allows investors to evaluate the annual return specifically on their equity. It's great for comparing different real estate investments and helps in making informed decisions about buying or selling properties. It's particularly relevant when leverage, like a mortgage, is involved. What influences cash-on-cash return? Several things can affect this metric. Invested equity. This is the amount of your own money you put in. Annual cash flow. This is the cash you have left from rental income after paying all property expenses, including mortgage payments. Leverage. Using borrowed money, like a mortgage, can significantly impact this. Generally, the lower your actual cash equity invested and the higher the annual cash flow, the higher your cash-on-cash return will be. How do we calculate cash-on-cash return? The formula is pretty straightforward. Cash-on-cash return equals annual cash flow divided by invested equity. Example of cash-on-cash return calculation. Let's say you purchased an investment property with the following details. Purchase price, $1 million. This is the total price of the investment property. Invested equity, $200,000. This is the amount of your own cash you put in. Annual cash flow, $100,000. This is the rental income you receive minus all operating expenses and mortgage payments for the year. Now let's calculate the cash-on-cash return. Cash-on-cash equals annual cash flow divided by invested equity. So cash-on-cash equals $100,000 divided by $200,000, which equals 50%. A 50% cash-on-cash return means that for every $100 of your own money you invested, you will receive $50 back in cash each year. Now, here's an interesting point. The net annual cash flow from the asset is $100,000. If you were to look at this $100,000 relative to the total property value of $1 million, that's a 10% return. However, the return on the actual money the investor spent out of pocket is a much higher 50%. This difference highlights the power of leverage. The $800,000 mortgage allows the investor to control an asset worth 5 times their invested equity. When the asset generates positive cash flow after covering all expenses, including the mortgage, the return on the investor's personal equity is significantly amplified. To put it in contrast, if the investor had purchased the asset entirely with their own equity, paying $1 million in cash, their cash on cash return, and also their return on equity, which we'll discuss next, would have been $100,000 divided by $1 million, which is 10%. This clearly shows why cash on cash return is an especially important metric for investors who use leverage in real estate. It shows the true cash return on the money they personally risked. Now that we understand cash on cash, let's look at a broader measure of profitability related to equity, return on equity. Return on equity, ROE. When you invest in a company or when shareholders invest in a real estate company, how effectively is that invested capital being used to generate profits? This is where return on equity, or ROE, comes into play. Return on equity is a financial metric that shows a company's net income as a percentage of its shareholders' equity. Shareholders' equity is basically the company's net worth. What would be left for shareholders if the company sold all its assets and paid off all its debts? In simple terms, ROE tells you how much profit a company generates for every dollar invested by its shareholders. How do we calculate ROE? The formula is ROE equals net income divided by average shareholders' equity multiplied by 100. Let's clarify those terms. Net income. This is the company's profit after all expenses, including taxes, have been deducted. It's the bottom line profit. Shareholders' equity. This is total assets minus total liabilities. Average shareholders' equity. Since equity can change throughout the year, we often use an average. This is calculated as shareholders' equity at the beginning of the year plus shareholders' equity at the end of the year divided by 2. Return on equity has two main parts: net income, the numerator, and equity, the denominator. A change in either will affect the metric, but we need to be careful how we interpret these changes. Consider this. How can ROE increase? A good increase in ROE. This happens when net income goes up while equity levels remain stable or even grow. This kind of increase reflects positive things like efficient operations, increased sales, better profit margins, or wise management decisions. This is a healthy increase because it shows a genuine improvement in the company's business performance. A dangerous or artificial increase in ROE. What if ROE rises only because the company is taking on a lot of debt? When a company uses more debt instead of equity to finance its operations, the equity portion, the denominator in the ROE formula, gets smaller. This can make ROE go up, even if the actual profits haven't improved. Why is this dangerous? Debt increases financial risk. More debt means more fixed payments, which can be a problem if profits dip. Financing costs, interest on the debt, might eat into profitability in the future. The profitability might look high, but it might not be truly genuine or sustainable. Example, let's look at two companies. Company A, net income equals $100,000, equity equals $1 million. Its ROE equals $100,000 divided by $1 million multiplied by 100 equals 10%. Company B, net income equals $100,000, same profit, equity equals $500,000, but it also has debt equals $500,000. Its ROE equals $100,000 divided by $500,000 multiplied by 100 equals 20%. Company B has a much higher ROE, 20% versus 10%. Both companies earn the same profit, but Company B appears more profitable with ROE simply because it has higher leverage, more debt, and less equity. This doesn't necessarily mean better performance, it just means higher financial risk. So, the key takeaway is Always consider debt levels when looking at ROE. A high ROE driven mainly by debt can be misleading. When ROE is high, it's important to check if it's due to real growth in net income or just due to increased financial risk from more debt. Main uses of ROE. ROE is a critical metric used by investors, analysts, and company management for several key reasons. Profitability indicator. ROE clearly shows how much profit is generated for every dollar of shareholder equity. A higher ROE generally means stronger profitability. Company comparison. Return on equity is very helpful for comparing companies within the same industry. It helps to see which companies are using their shareholders' equity more efficiently to generate profits. Management insight. A rising ROE can suggest that management is effectively using the funds provided by shareholders to grow profits and enhance shareholder value. Investment screening. Investors often look for companies with a consistently high ROE as a sign of strong past performance and good future potential. Example of ROE calculation. Let's say Alpha Company has the following data. Annual net profit, $500,000. Shareholders' equity at the beginning of the year, $2 million. Shareholders' equity at the end of the year, $2,500,000. First, we need to calculate the average shareholders' equity. Average shareholders' equity equals $2 million plus $2.5 million divided by 2 equals $2.25 million. Now we can calculate ROE. ROE equals net profit divided by average shareholders' equity multiplied by 100. So ROE equals $500,000 divided by $2,250,000 multiplied by 100 equals 22.22%. This means that Alpha Company generates a profit of $22.22 for every $100 invested by its shareholders. Let's look at a table comparing ROE and COC. Both help assess an investment's performance, but they focus on different aspects and provide different insights. Let's illustrate the difference with an example. Data. Asset value of $1 million, equity of $200,000, annual net cash flow of $20,000, annual net profit of $10,000. Let's start with cash on cash return. The formula to calculate COC is you take the annual net cash flow, divide it by the invested equity, and then multiply by 100. For calculation example, the COC would be $20,000 divided by $200,000 times 100, which results in a 10% cash on cash return. Now let's look at return on equity, ROE. The formula for ROE is the annual net profit divided by the invested equity multiplied by 100. As an example calculation, the ROE would be 10,000 divided by 200,000 times 100, which equals 5%. So, to summarize, COC is excellent for understanding direct cash returns on your cash invested, especially favored in real estate for its cash flow insight. ROE, on the other hand, gives a broader view of overall profitability based on net profit and is a standard for evaluating a company's performance or an investment's comprehensive ability to generate returns on equity. Why is there a difference? In this example, COC, 10% is higher than ROE, 5%. The difference often comes down to non-cash expenses. Net profit, which is used in the ROE calculation, is lower than annual net cash flow used in COC because net profit includes expenses that don't involve an immediate cash outlay in the same year. A common example is asset depreciation. Next, let's broaden our view from just equity to the total investment. Return on investment, ROI. When you make any investment, whether it's buying a property, starting a project, or even launching a marketing campaign, a fundamental question arises. For every dollar I put in, how much am I getting back? This is what return on investment, or ROI, helps us answer. ROI is a financial metric that represents the return on an investment, essentially, the profit or loss generated from the investment relative to the amount of money invested. In very simple terms, ROI shows you how much money you made or lost for every dollar you put into something. ROI is widely used for evaluating the viability of investments. Is this investment likely to be profitable? Comparing the profitability of different investments. If you have several options, ROI can help you see which one might give you the best bang for your buck and making informed investment decisions. Interpreting ROI. Generally, the higher the net profit from an investment and the lower the amount invested, the higher the ROI will be. A high ROI indicates that the investment is efficient, profitable, and generating strong returns relative to its cost. Limitations of ROI. While ROI is a simple and easy to use metric, it does have a key limitation. It typically does not take into account the time value of money. This means it doesn't differentiate between profits earned quickly versus profits earned over a long period. For this reason, it's primarily used for a quick comparison of investments, but it probably shouldn't be the only measure you rely on for complex decisions. How do we calculate ROI? The formula for ROI is ROI equals net profit from investment divided by investment amount multiplied by 100. Let's look at a very straightforward example. Investment. You invest $10,000 in a project. Net profit. The project generates a net profit of $15,000. Let's calculate the ROI. ROI equals $15,000. Net profit divided by $10,000. Investment multiplied by 100 equals 150%. What does this 150% ROI mean? It means that for every dollar you invested, your return is $1.50. You got your original dollar back plus an additional $1.50 in profit. We've talked about ROE and now ROI. What's the key difference when we think about them, especially in real estate? ROI measures the return on the total investment, which can include both your equity and any debt used to finance the investment. Is not directly affected by leverage in the same way ROE is, though interest on debt would reduce the net profit, thus lowering ROI. ROE measures the return on equity only, is greatly affected by leverage. In the real estate world, ROE is particularly relevant when leverage like mortgages is involved. It helps understand how efficiently the investment in equity is generating returns for the actual equity holder. Example, illustrating the difference between ROI and ROE. Let's imagine an investor wants to buy a real estate asset worth $1 million. We'll look at two scenarios. Scenario 1, acquisition with full equity, no leverage. The investor pays the full $1 million from their own funds. No debt is used. After 1 year, the asset's value increases, and let's say after selling and accounting for all costs, the net profit gain is $100,000. So the asset is now effectively worth $1,100,000 if sold. ROI calculation, ROI equals net profit divided by total investment cost multiplied by 100. So ROI equals $100,000 divided by $1 million multiplied by 100 equals 10%. ROE calculation. Since the entire investment was equity, ROI and ROE are the same. Scenario 2, acquisition with leverage, mortgage. The investor pays $200,000 from their own funds. This is their equity. They take out a mortgage for the remaining $800,000. After 1 year, the asset value also increased to $1,100,000, same as scenario 1. So the gross gain is $100,000. However, in this scenario, the investor also had to pay mortgage interest. Let's say the interest paid during the year was $40,000. So the net profit for the investor is the gain minus the interest. $100,000 gain minus $40,000 interest equals $60,000. ROI calculation. The total investment cost, the asset's price, is still $1 million. The net profit is $60,000. ROI equals $60,000 divided by $1 million multiplied by 100 equals 6%. ROE calculation. The equity invested by the investor was $200,000. The net profit after interest is $60,000. ROE equals $60,000 divided by $200,000 multiplied by 100 equals 30%. Explanation and conclusions from the example regarding the ROI metric. ROI measures the profit relative to the total cost of the asset, $1 million. In scenario 2, with leverage, the ROI is lower, 6%, compared to scenario 1, 10%. This is because the interest expenses on the mortgage reduce the overall net profit from the asset. Regarding the ROE metric, return on equity measures the profit relative to the actual equity the investor put in. In scenario 2, the ROE is significantly higher, 30%, compared to scenario 1, 10%. This is due to the effect of leverage. The investor used a smaller amount of their own money to control a large asset, and the profits, even after interest relative to that smaller equity stake, were magnified. Conclusion: leverage can significantly increase ROE, making the return on the investor's actual cash outlay much higher. However, it's crucial to remember that leverage also increases risk. If the asset's value had declined, or if rental income hadn't covered costs, the losses would also be magnified for the equity investor. This brings us to another important return metric that looks at profitability in relation to all assets, not just the total investment cost or equity. Return on assets, ROA. So far, we've looked at returns on our specific investment, ROI, and returns on our own cash put in, equity metrics like cash on cash and ROE. But how efficiently is a company using all of its assets, everything it owns, to generate profit regardless of whether those assets were bought with owner's money or with borrowed money? That's what return on assets, or ROA, tells us. ROA is a financial metric that measures a company's profitability in relation to its total assets. What does ROA mean? It measures how efficient a company is at using its assets to generate profits. It indicates how much profit a company generates for every dollar of assets it owns. This is regardless of how those assets are financed, whether through equity from the owners or debt from lenders. Why is ROA important? It allows for a comparison between companies, even if they have different levels of financial leverage. Because it looks at profits relative to all assets, it neutralizes the effect of how those assets were paid for. It's important for both investors and managers because it helps evaluate the efficiency of a company's asset management and its fundamental ability to generate profits from what it owns. Interpretation: a high ROA value generally indicates an efficient and profitable company. It means the company is doing a good job of using what it has to make money. The formula for return on assets is return on assets equals net income divided by average total assets multiplied by 100. We use average total assets because asset levels can change during a period. Real estate example for ROA. Let's say a real estate company has the following total asset value. It owns assets worth $10 million. Annual net profit. It generates an annual net profit of $500,000. Let's calculate the ROA. ROA equals 500,000 divided by 10 million multiplied by 100 equals 5%. This 5% return on asset means that for every dollar of assets the company owns, it generates 5 cents of profit. Let's quickly compare three key profitability ratios: ROE, ROI, and ROA, highlighting what makes each distinct. First, return on equity. Its unique focus is on profitability from the shareholder's perspective. It asks how much profit is generated for the owner's stake in the company. The key to this is its denominator, shareholders' equity. A major distinguishing factor is its high sensitivity to financial leverage. More debt can significantly increase or decrease ROE. Next, return on investment. Its unique focus is on the efficiency or gain from a specific individual investment or project relative to its cost. The denominator here is the cost of that particular investment. The main difference is its versatility. Return on investment can be applied to almost any type of investment. Finally, return on assets. Its unique focus is on how efficiently a company uses all its resources, its total assets, to generate profit, regardless of how those assets are financed. The denominator is total assets. A critical difference from ROE is its lower sensitivity to leverage. This gives a clearer picture of operational efficiency in utilizing the asset base. So, to quickly recap the core differences, return on equity measures return to owner's equity and is heavily influenced by debt. ROI measures return on a specific investment's cost and is highly adaptable. ROA measures return generated by all company assets and is less affected by debt, focusing on operational efficiency. Understanding these distinctions helps you choose the right metric for the specific financial question you're trying to answer. Now let's shift gears slightly and talk about returns in the context of inflation. Nominal return and real return. When we talk about investment returns, say 10% a year, is that 10% telling the whole story about how much our purchasing power has actually increased? What if prices for everything else went up by 5% that year? This is where the concepts of nominal return and real return become very important. Nominal return. What is it? Nominal return is the total income generated by an investment before accounting for inflation. It measures the change in the monetary value of your investment, but it doesn't tell you about the change in how much you can actually buy with that money, your purchasing power. It's important to note that in most cases, when people refer to financial returns or yields, like in the various metrics we've discussed so far, they are usually talking about nominal returns unless specified otherwise. How do we calculate nominal return? The formula is nominal return equals final value minus initial value divided by initial value multiplied by 100. Real return. What is it? Real return is the return you get from an investment after deducting the impact of inflation. It measures the actual change in the purchasing power of your investment. This gives you a much truer picture of your profitability. Why is it important? Especially during periods of high inflation, it's crucial to adjust returns for inflation to understand the real gain. If your investment grew by 7% but inflation was 10%, your purchasing power actually decreased. How do we calculate real return? The more precise formula is real return equals 1 plus nominal return divided by 1 plus inflation rate minus 1. There's also a commonly used approximate formula, which is simpler. Real return is approximately equal to nominal return minus inflation rate. This approximation works well when inflation rates are relatively low. Example of nominal and real return. Let's make this clearer with an example. Suppose an investor purchased an investment property for $1 million. After 1 year, the value of the property increased to $1,100,000. The inflation rate during that year was 5%. Calculation of nominal return. Nominal return equals $1,100,000 minus $1 million divided by $1 million multiplied by 100 equals 10%. So the nominal return is 10%. The investment grew by 10%. Now let's calculate the real return. Using the precise calculation, real return equals 1 plus 0.1 divided by 1 plus 0.05 minus 1 equals 4.76%. Using the approximate calculation, real return approximately equals nominal return minus inflation rate equals 10% minus 5% equals 5%. As you can see, the precise calculation gives 4.76% and the approximation gives 5%. The approximation is close, but the precise formula is more accurate. What does this mean? The investor earned a 10% return in dollar terms, nominal return. Their actual gain in terms of purchasing power, real return, was only 4.76%. Inflation ate away some of that nominal gain. This is a very important distinction for long-term investment planning. Next, we'll discuss a very common metric used in real estate to value income-generating properties: the capitalization rate. Capitalization rate, cap rate. If you're looking at an income-generating property like an apartment building or a shopping center, how can you quickly gauge its potential return relative to its current market price? This is where the capitalization rate or cap rate is extremely handy. What is capitalization rate? Cap rate. The cap rate is a metric used to evaluate the value and potential return of an income-generating real estate asset. It's calculated by finding the ratio between the asset's annual net operating income and its current market value. Let's break down those terms. Net operating income is the property's annual income, from rents, etc., after deducting all operating expenses but before deducting mortgage payments and income taxes. Current market value. This reflects what the property is worth in the current market based on prevailing conditions. So, the cap rate essentially represents the expected annual percentage return on the investment if you were to buy the property with all cash, no loan, relative to its current market value. Key uses of cap rate. Cap rate is a cornerstone in real estate for several reasons. Valuation of assets. It provides a way to estimate the value of a property based on its income. Comparison of returns. It allows investors to compare the potential returns on different income-generating real estate investments. Making informed investment decisions. It helps in deciding whether to purchase or sell real estate assets. What influences the cap rate? Several factors can influence the cap rate for a property or in a market. Risk. This is a big one. When the perceived risk of an investment is lower, investors are often willing to accept a lower rate of return. This is reflected in a lower cap rate. Conversely, higher risk often leads to higher cap rates as investors demand more compensation. Location. Assets in highly desirable, prime locations typically have lower cap rates. Why? Because investors often expect these assets to generate higher future returns through rent growth or appreciation, and are therefore willing to accept a lower immediate rate of return. Market conditions. Cap rates can vary based on broader market conditions, such as prevailing interest rates, the overall economic climate, and the supply and demand for specific types of properties in a particular area. For example, if interest rates are very low, cap rates might also trend lower as real estate becomes a more attractive investment relative to other options. How do we calculate the cap rate? The formula for cap rate is cap rate equals net operating income divided by current market value. What does the cap rate mean for buyers and sellers? Interpreting a high cap rate. When the cap rate is high, it generally indicates that the investment requires less capital, a lower price relative to the income the asset generates. This could mean a higher net return on the invested capital if you bought it at that price. For buyers, a high cap rate can be desirable because it suggests they might be acquiring an asset at a relatively lower price in relation to its income, potentially allowing for a quicker return on investment. The catch with high cap rates. However, a high cap rate isn't always a good thing without context. It can also indicate higher risk. Perhaps the property's value is low because it's in a problematic area, has high vacancy rates, or there's a general lack of demand. So sometimes a high cap rate can signal high risk or potential difficulties in renting or selling the property in the future. In summary, a high cap rate doesn't automatically mean the investment is a good buy. It's always necessary to dig deeper and understand the reasons behind that capitalization rate value. Is it high because it's an undervalued gem, or is it high because it comes with significant risks? To illustrate a cap rate calculation, let's use an office building as an example. The office building generates an annual net operating income of $100,000 per year. The current market value of this building is $1 million. Now let's calculate the cap rate. Cap rate equals annual net operating income divided by market value equals $100,000, divided by $1 million equals 10%. A cap rate of 10% means that the investor can expect to receive a 10% annual return on their investment in the building based on its net operating income and current market value. For every dollar invested in the building at this price, the investor expects to receive 10 cents in annual net operating income. It indicates the building generates an annual return of 10% relative to its current market value before considering financing. Cash on cash versus cap rate. Let's compare between two fundamental metrics: cash on cash return and capitalization rate. Understanding the distinction between these is crucial. First up, we have cash on cash return. If you look at the numerator for cash on cash, you'll see it's the annual cash flow after financing. It's the net operating income minus the mortgage payment. This gives us the actual cash flow remaining for the investor after paying all expenses, including financing costs. This is the money that actually ends up in the investor's pocket at the end of the day. Next, let's look at the denominator for cash on cash. This is the equity invested, the amount the investor spent out of their own pocket to acquire the property. So, it's their actual cash contribution. The key difference here is critical. The cash on cash focuses on the return on the investor's personal investment and therefore takes financing costs into account. It's very specific to that investor's deal structure. Okay, now let's shift gears and look at the capitalization rate. Notice the numerator here is different. It's the net operating income. This is the total income from the property less operating expenses, without considering financing costs. It reflects the income-generating potential of the property itself. What about the denominator for cap rate? That's the current market value, regardless of how it is financed. The cap rate focuses on the income-generating potential of the property, and therefore ignores financing costs and focuses on the overall market value of the property. So, to sum up what this table is showing us, cash on cash return tells an investor what return they are making on their specific cash invested, factoring in their loan. The cap rate, on the other hand, gives a broader view of the property's earning power relative to its market price, without regard to any specific financing. Both are valuable, but they tell us different things. Let's use an example to highlight the difference between cash on cash and cap rate. Data, a real estate asset, is purchased for $1 million, which is also its current market value. The annual net operating income is $100,000. The cash investment, equity, made by the investor is $200,000. The other $800,000 was a mortgage. The annual mortgage payment, principal and interest on the asset is $50,000. Calculation of cash on cash return. First, calculate the annual cash flow after mortgage. Annual cash flow equals net operating income minus mortgage payment equals $50,000. Next, calculate cash on cash. Cash on cash equals annual cash flow divided by invested equity equals $50,000 divided by $200,000 equals 25%. Calculation of capitalization rate. Cap rate equals net operating income divided by market value. Cap rate equals $100,000 divided by $1 million equals 10%. Conclusions from this example. The cap rate, 10%, gives a picture of the profitability of the asset itself, as if it were bought with cash. The cash-on-cash return, 25%, provides a picture of the profitability of the actual cash investment made by the investor, taking into account their specific financing, the mortgage. In this case, the cash-on-cash 25% is higher than the cap rate 10%. This is due to the use of leverage, the mortgage. When using leverage, cash on cash will generally be higher than cap rate if the property's return, as indicated by cap rate, is greater than the cost of the debt. The decrease in the invested equity, the denominator for cash on cash, is usually more significant proportionally than the decrease in cash flow due to the debt payment, the numerator for cash on cash, thus amplifying the cash on cash return. Gross rent multiplier versus cap rate. Let's quickly look at this table comparing GRM and cap rate, two key real estate valuation metrics you need to know. First, we have the gross rent multiplier. It uses gross income, meaning before any expenses. The formula is simply property value divided by annual gross income. Because it ignores expenses, its use is limited to a quick, rough estimate. Think of it as a first-glance tool, not for detailed decisions. Next, the capitalization rate. This is generally more useful. It uses net operating income, which is your income after deducting operating expenses. The formula is NOI divided by property value. Since it includes operating expenses, it gives you a much better picture of the property's true yield and is essential for any in-depth analysis. When to use which? When you are initially screening many potential investments, GRM can be a quick way to get a rough idea. However, for a more serious analysis, cap rate is generally preferred. It's important to use both metrics in the right context and understand their limitations. Cap rate is generally considered a more comprehensive and reliable metric for evaluating income-generating assets because it does take operating expenses into account, giving you a clearer picture of the property's ability to generate net income. Now, let's move on to a metric that tells you how many times over you get your initial equity back. Equity multiple. When you invest your own cash, equity, into a project, over the entire life of that investment, how much total cash do you get back compared to what you put in? Did you double your money? Triple it? This is what the equity multiple tells you. The equity multiple is a financial metric that represents the total return an investor receives on their equity capital invested over the complete life of the investment. In simple terms, the equity multiple shows how many times over you got your initial equity investment back in total cash returns. For example, an equity multiple of 2.0x means you received $2 for every $1 of equity you invested. Why is it important? It's used for evaluating the overall profitability of an investment across its entire holding period, comparing the total cash return profitability of different investments, assisting in making informed investment decisions. Equity multiple equals total cash return to equity divided by total equity invested. Total cash return to equity includes all distributions of cash to the equity investor during the holding period, plus the return of capital and any profit at the time of sale or exit. Total equity invested is the initial cash put in by the equity investor, interpreting the equity multiple. If equity multiple is greater than 1, the investment is profitable, you got back more than you put in. If equity multiple is less than 1, the investment resulted in a loss. You got back less than you put in. If equity multiple equals 1, the investor received back exactly the amount of equity capital they invested. Break even in terms of cash returned versus cash invested, but no profit. You'll often hear terms that sound very similar. The equity multiplier versus the equity multiple. It's important not to confuse the equity multiplier with the equity multiple, as they are distinct financial metrics measuring different aspects. Example of calculating equity multiple. Imagine an investor makes an initial equity investment in a real estate project. Initial equity investment, $100,000. During the investment period, let's say 5 years, the investor receives profit distributions from net operating cash flow, $50,000 in total over the 5 years. At the end of the investment period, year 5, the property is sold and the investor receives sale proceeds, their share after debt repayment and selling costs, $200,000. Now let's calculate the equity multiple. Calculate total cash inflow, total cash returned to equity. Total cash returned equals profit distributions plus sale proceeds equals $50,000 plus $200,000 equals $250,000. Calculate equity multiple. Equity multiple equals total cash return divided by initial equity investment equals $250,000 divided by $100,000 equals 2.5x. The equity multiple is 2.5. This means the investor received $2.5 in total cash for every $1 of equity they originally invested over the entire life of the project. How does equity multiple compare to ROI? Let's take a closer look at this table. It does a great job of highlighting the crucial differences in what actually makes up those formulas. This is key to understanding why these two metrics, while both measuring returns, give us different perspectives. First, let's focus on ROI, return on investment. ROI formula: net profit divided by investment amount multiplied by 100. ROI represents the return as a percentage. An easy way to think about it is that 100% ROI means your net profit equals your investment, essentially doubling your original amount. Now, let's dissect the components. The numerator is net profit. The key point here is that it focuses on profitability and include non-cash items like depreciation. This means it's often more of an accounting figure than a pure cash figure. The denominator is the investment amount, include equity plus debt. This means ROI is calculated based on the total cost of the asset, regardless of how much was borrowed. Now, let's switch over to the equity multiple. Equity multiple formula, total cash return divided by total equity invested, represents the return as a multiple of the equity. For example, an equity multiple of 2.0x means you have received cash totaling twice your original investment. Looking at its components, the numerator is total cash returned. It focuses on physical cash returned to the investor. We're not talking about paper profits or non-cash items. This is strictly about the money that actually comes back into your pocket. And the denominator is total equity invested. This is only the cash you personally invested, your skin in the game. It excludes any borrowed money. So, when you look at them side by side, the distinctions become very clear. ROI gives you a percentage, often based on accounting profit and the total project cost. Equity multiple gives you a multiplier based purely on actual cash received versus actual cash invested by you. Understanding this difference is fundamental when analyzing real estate deals, especially when leverage is involved. The core difference between cash-on-cash return and equity multiple. First, let's focus on cash-on-cash return. Notice its time horizon, it's annual. Think of it as a snapshot. It tells you what's happening in one specific year and what is measured. It's the current cash flow for that particular year, just the cash generated from operations during that 12-month period. So fundamentally, the main question TOC answers is, how much cash am I receiving this year? It's about the immediate yearly return on your cash. Now, let's contrast that with the equity multiple. Its time horizon is completely different. It covers the entire investment period, from the day you buy to the day you sell. It's cumulative. Consequently, what it measures is the total cash received. And this is key. It includes both the ongoing cash flow and the proceeds you get when you finally sell the property. Therefore, the main question equity multiple answers is, how much cash will I receive in total? It's about the overall multiplication of your initial investment over the long haul. So, in essence, TOC is your annual performance snapshot, focusing on current income. Equity multiple is your lifetime performance score, focusing on total return, including your exit. They answer two distinct but very important questions about your investment. Next, let's consider the simplest way to look at a return: the absolute gain or loss. Absolute return. Sometimes you just want to know in straightforward terms how much an investment has grown or shrunk in total without comparing it to anything else or worrying about how long it took. This is what absolute return tells you. What is absolute return? Absolute return is the total profit or loss achieved by an investment expressed as a percentage of the initial value without comparison to a benchmark. It simply measures the change in the investment's value from the beginning to the end of a period. For a more complete picture, you'd often look at other metrics alongside it, but absolute return gives you that raw gain or loss. How do we calculate absolute return? The formula is absolute return equals final value minus initial value divided by initial value multiplied by 100. When to use absolute return? It's useful for evaluating the performance of a single investment over its entire holding period. It can be relevant for short-term investments where annualization might not be as meaningful. Advantages of absolute return. It's simple to calculate and very easy to understand. It's useful for investments with a fixed horizon or for understanding the overall gain or loss on a one-time investment. It provides the basic picture of total percentage gain or loss, allowing for an initial assessment. Disadvantages of absolute return: ignores time. It doesn't tell you how long it took to achieve that return. A 20% absolute return over 1 year is very different from a 20% absolute return over 10 years. Not annualized, this makes it hard to compare with other investments that might have different holding durations. This calculation does not reflect the effects of compounding, a crucial element when inferring an annual rate. Can be misleading for multi-year investments or investments with irregular cash flows if you're trying to gauge ongoing performance. Example of absolute return. Let's say you purchase a property for $1,500,000. You sell it after 5 years for $1,650,000. Let's calculate the absolute return. Absolute return equals $1,650,000 minus $1,500,000 divided by $1,500,000 multiplied by 100 equals 10%. Conclusion from this example. Over the entire 5-year period, your investment grew by 10% in total. That means you earned a $150,000 profit, regardless of how long it took. It tells you how much money you gained in percentage terms over the whole period, but it doesn't tell you how efficiently it grew on a per-year basis. This 10% is not an annual return. It's a simple metric to understand the overall gain or loss. Quite ideal for thinking about one-time investments from start to finish. But what if we do want to know the average growth per year, especially over longer periods, and account for compounding? That leads us to our next metric: annual growth rate, CAGR. We just saw that absolute return tells us the total growth but not the yearly rate. If an investment grows over several years, how can we find a single smooth average annual growth rate as if it had compounded steadily? This is where the compound annual growth rate, or CAGR, is very useful. Compound annual growth rate is a metric that represents the average annual growth rate of an investment over a specific period, assuming the profits are reinvested during the term of the investment. It essentially smooths out the bumps of volatile annual returns and gives you a constant, hypothetical growth rate, as if the investment grew at that steady rate each year with compounding. One important thing to note is that the basic CAGR formula typically only focuses on the starting value and the ending value of the investment over a number of years. It doesn't take into account any additional cash flows, like new investments or withdrawals. that might have occurred within the investment period. CAGR is valuable for several reasons. Comparing investments with different time periods. It allows you to compare the performance of investments held for different lengths of time by converting their overall return to an annual basis. This makes for a more apples-to-apples comparison. Evaluating long-term performance, it provides a clearer picture of the average performance of an investment over time, especially when there's been market volatility, ups and downs year to year. Comparing to benchmarks, CAGR allows you to compare your investment's performance to relevant benchmarks, like the S&P 500 stock market index or a real estate market index, to see if your investment is outperforming or underperforming the broader market. Presenting data to investors, it's a common and relatively easy to understand metric for summarizing investment performance over a period. How do we calculate CAGR? The formula is CAGR equals ending value divided by beginning value raised to the power of 1 divided by number of years minus 1. Let's break down the components. Beginning value. This is the value of the investment at the start of the period you're measuring. Ending value. This is the value of the investment at the end of that measured period. Number of years, N. This is the length of time in years over which you're calculating the growth rate. Example of CAGR calculation. Suppose you purchased a real estate asset in the year 2020 for a price of $1 million. In the year 2025, you sold it for a price of $1.5 million. The number of years is 2025 minus 2020 equals 5 years. What is the CAGR on this investment? Let's plug the numbers into the formula. CAGR equals 1,500,000 divided by 1 million raised to the power of 1 divided by 5 years minus 1. CAGR equals 1.5 raised to the power of 0.2 minus 1. CAGR approximately 0.08447. To express this as a percentage, we multiply by 100, so CAGR approximately 8.45% per year. What does this result mean? The overall relative growth, absolute return, was $1.5 million minus $1 million, divided by $1 million equals 50% over 5 years. But if we want to express this as an average annual compounded rate, the CAGR tells us it's approximately 8.45% per year. This means the investment grew at an average annual rate of 8.45%, as if you had earned exactly 8.45% each year on the cumulative amount from the previous year. This provides a simple and uniform annual metric that's very useful for comparing this investment against other investments or benchmarks. That was a lot of return metrics. Each one gives us a different lens through which to view investment performance.